Corporate finance practice problem using Excel. Rights offering and the impact on the earnings per share calculation and price earnings ratio. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, you're going to populate that in the blue area on the right and on down below. We've got a rights offering once again. This time our focus on the change to the calculations of the earnings per share and the price earnings ratio. Remember that the rights offering, typical idea, corporation wants capital. They want to issue stocks to do so. Stocks are already out there. Therefore, they want to give a benefit to the existing stockholders, possibly to buy it at a discounted price with the use of the rights offering. For a more basic problem on the rights offering and how it works, take a look at some of the prior examples. Here, we're going to focus on the impact on some of our other ratios, such as the earnings per share. So we're going to imagine the shares outstanding are the 4 million. The market price rights on, so the market price is going to be 50. The net income for the company, we're going to say, is the $13 million. Then we have a rights offering. We're going to assume that in the rights offering, new shares that are going to be sold are 571,429 new shares. The price per share, we're going to say, are going to be 44. That's going to be the discounted price that we would assume that they're going to be sold for. And then the rights needed for the new share are going to be 7. So it takes 7 rights in order to buy the share at the discounted price. So we are imagining then the current shareholders that are outstanding, the 4 million shareholders, are going to get 1 right per share, and they need to collect 7 of those rights in order to purchase 1 more share at the discounted price of $44 below the current market price of the $50. Now, when this happens, you can see that you would think that the value of the stock earnings per share or the stocks would basically go down, right? Because you would think that they're issuing the stocks, they're going to get money. Money's going to go up, but they're getting less money than the current value of the stock. So you would think then that the impact on the actual share price after this whole thing is said and done would be slightly less, right? There'd be more shares out there, and because they didn't get the market value, then you would think the shares themselves would be slightly less per share. But now we want to focus in on the earnings per share. So let's do our starting point for the earnings per share. Typical calculation would be the earnings, the net income, the performance number over time. We're going to say is the 13 million. And then we have the number of shares that are outstanding before we do anything, which is the 4 million shares. Dividing that out, that's going to give us our earnings per share. And that's going to be equal to the 13 divided by the 4. Adding some decimals, number group, couple decimals, we're at the about 3.25. And I'm going to underline font group and underline that. Then let's take a look at our price earnings ratio before we do anything. So we're going to say the market price now is going to be the price up top. Market price is going to be 50. And then we've got the earnings per share that we just calculated is going to be the 3.25. That's going to be our price earnings ratio, which is going to be the 50 divided by the 3.25. Let's add some decimals to these two down below. Numbers group, adding a couple decimals. And let's give it an underline here as well. Font group and underline. So we're at the 1538 at the starting point. So now we're going to imagine that we have our offering that takes place. What's going to be the value of 1 right? We're going to use our calculation for the rights value, cum rights period, equal to the stock price minus the rights subscription price per share divided by the number of shares required to buy 1 share plus 1. So we're going to have the selling price. We're going to say that the shares market price is going to be 50. We're going to take the 50, and then we've got the subscription price. So I'll call it the subscription price here. That's going to be the price that we can buy it at if we take advantage of the discounted rate, which we had at the 44. Underlining that, font group and underline. We'll call that the numerator, the difference, the num. And that's going to be equal to the 50 minus the 44, or 6. And then we're going to say the rights needed for 1 share. How many rights is it going to take? We need 7. So we're going to say 7 of those. And then we add 1 according to our formula up top. Underlining that, that'll then be the denominator, the denom. So the denom is going to be equal to the sum of the 7 plus 1 or the 8. Let's underline that, font group and underline. That's going to give us the value of 1 right. So we're going to say the value of 1 right is equal to the numerator divided by the denominator, and that's going to give us our number group, adding a couple decimals, the 0.75 about there. So then we're going to calculate our rights on price. So the rights on price, we're going to say, well, the market price, let's pick up the market price once again at the 50 up top. We're going to pick up the market price at the 50. And then we have the value of our 1 right, the value of the 1 right at the 0.75. Let's go ahead and go to the font group and add some decimal number group, add some decimals, underline that font and then underline. And then we'll subtract that out. We're going to say 50 minus the 0.75. Then go to the number group, add a couple decimals. We're at the 49.25 about for the X right price. X right's price. We can also get to that number this way if we look at the total or aggregate type of calculation, the theoretical X right price, the TERP. We can calculate then once again, picking up the market price at the 50. And let's see where we started or where we were at before the change happened. We're going to say the shares that were outstanding at that point in time were the 4 million shares outstanding. Let's underline that. We're going to go to the font group and underline. Let's make this one bold. I don't know why it got unbolded. Multiplying that out, we're going to say the 50 times the 4 million. That's going to give us our starting value. So that would be basically what the market thinks the value is at the beginning. I indented that in the alignment group here. And then we're going to say, okay, well, what happens then is the new shares are going to be issued at the new price. The new price is going to be equal to the $44. And the number of shares that we're going to issue, we're going to say is equal to that 571,429. Let's underline that, font group and underline. That then is going to give us the new capital that's going to be invested, the new money going into the business. I indented that once again, alignment and then indent of the 44 times the number of shares issued. So that's another 25, 142,857. So that's going to give us the total value after the new shares are issued. So after the new shares are issued, we then have our value summing this up of the 225, 142,857, and that's going to give us our new. And then if we look at our number of shares at this point and compare it to the number of shares, we now had 4 million, and we issued another 571,429. Underlining that, font group and underline, that's going to give us what we'll call here our theoretical X rights. I'm going to unindent that. And we're going to then take, this will be equal to this number divided by this. That'll give us our 49, adding a couple decimals, 49.25. Once again, I'm going to put an underline here. So you can kind of think of it in aggregate this way as well. And you'll often see if calculations in that format. So that could help. And just realize, of course, that after we're contemplating that after these are going to be issued, note that we have a price that's going to be less than the starting price due to that, of course, we have more shares out there that would dilute it. But the cash also went into the business, but the cash went into the business at a price less than the market price, resulting in the price per share we would expect to be lower. Now let's calculate our earnings per share after this takes place. So now we're going to say, all right, the earnings, we're still going to be looking at the net income of the 13 million on the earnings, and the number of shares that are out there at this point in time. I'm going to say number of shares are now going to be equal to, once again, that original amount that we had out there of the 4 million, plus we issued another 571,429. Add or underlining that, font group and underline. That's going to give us the earnings per share, which I'll just type in here. The earnings per share, which is going to be equal to the 13 million divided by the number of shares. Adding some decimals, number group, couple decimals, we're now at the 2.84. So clearly the earnings per share lower. We've got more shares that are going to be out there. Earnings per share going to be lower. But of course, If you were an existing stockholder, you might have more shares if you purchased them at basically that discounted price. If we then look at our price earnings ratio, we got the price. So let's pick up the price, which is going to be that 49 now. On the price, we're expecting 49.25, and then go into the number group and add some decimals. And then we're going to compare that to the earnings per share, which is the 2.84, adding some decimals, number group, couple decimals there. That's going to be the price earnings ratio. Price earnings ratio, which is going to be equal to the 49.25 divided by the 2.84, about, gives us the 17. Go up top, I'm going to add a couple decimals and underline font group and underline. We've got the price earnings ratio, the 17.32 compared to the price earnings ratio of the 15.38 before the rights offering. So again, that's another thing you could take into consideration, and just to, when you're thinking about basically what everything stands beforehand and after the rights offering takes place. Obviously, if you think about this calculation over here, before the rights were offered, we had the market price at the 50, then the rights were offered. If we then sell another 571,429, you're then thinking, well, now there's going to be more shares out there. More shares are now out there. You would think that would dilute basically the value to some degree, although the company did get cash for it as well, which would increase the value. That cash is not going to be on the income statement. It's not going to be included in the income because it's an equity type of transaction, but the cash is not equivalent to the current rate, and therefore you would think the value of the shares themselves would be less, although, again, the current holder, if they purchase new shares at the lower price, would then have more shares that would be represented as well. When you think about that with relation to calculations based on performance, such as the income earnings per share type of calculation, now there's going to be more shares out there. So we would, of course, expect then the earnings per share number to be lower. But if we're talking about existing shareholders, they purchased more shares at the discounted price, they might have more shares that would then have the less of the earnings per share calculation.